Welcome to today's video on auto loans and zero credit. First, we will unpack why financing a car solely to build credit often becomes an expensive mistake. Next, we will walk through realistic interest rates for first-time borrowers, the hidden insurance trap, and a smarter step-by-step plan to build credit without wasting money. Finally, we will end with practical takeaways and a quick quiz to check your understanding. Before we dive in, a brief disclaimer. This content is educational only and does not replace professional financial, legal, or tax advice. Everyone's situation is different, so please consult a qualified professional who can assess your individual needs and local regulations. With that in mind, let's move forward. Here is our agenda. First, we will cover the harsh reality facing zero credit borrowers. Next, we will break down how high APRs drain your cash. Then, we will highlight the insurance premium trap that many young buyers overlook. After that, we will present the secured credit card strategy that typically beats financing for building credit. We will finish with an action plan and a couple of quick quizzes to test your knowledge. To set the context, starting with no credit usually means lenders classify you as high risk. This is true even if you have steady income and offer a large down payment. While you might technically get approved on your own, the cost of approval is often punishing, with interest rates commonly exceeding 20%. Now let's visualize how lenders think about this. Let's break down what lenders see. First, with no credit history, you fall into a high-risk tier. As a result, lenders often quote APRs in the 20 to 29% range. Next, these high rates lead to higher monthly payments and slow principal reduction, meaning more of your early payments go toward interest. Finally, because a vehicle is a depreciating asset, you are paying a premium to finance something that loses value, a combination that can put long-term pressure on your budget. This pie chart shows a simplified estimate for a $10,000 loan at 25% APR over 48 months. The principal is $10,000, and the total interest paid is approximately $5,907. In other words, you would pay almost 60% of the original loan amount again just in interest. This estimate illustrates how quickly high APRs inflate your total cost. Here are illustrative estimates for a $10,000 loan. At 20% APR over 48 months, the monthly payment is about $304. The total paid is approximately $14,601, and the estimated interest is about $4,601. At 25% APR, the monthly payment is about $331. The total paid is approximately $15,907, and the interest totals about $5,907. These figures demonstrate how steep the financing cost becomes at high APRs. Let's compare paying cash versus financing to build credit. On the cash side, buying a reliable used vehicle under $10,000 means paying zero interest. Insurance costs are often lower for older vehicles, and your budgeting stays flexible without the burden of monthly debt payments. You can invest the money you save, accelerating future growth. On the financing side, zero credit borrowers frequently face 20 to 25% APRs. This results in thousands of dollars lost to interest on a depreciating asset, often coupled with higher insurance premiums for newer financed cars. Financing introduces payment risk if income fluctuates and slows wealth building due to the drag of debt. Next, let's address the insurance trap. For young drivers, insurance premiums can exceed the car payment itself. It is crucial to obtain an insurance quote before you buy any vehicle to avoid surprise costs. Additionally, newer financed vehicles typically require higher coverage levels, increasing premiums further. These combined costs can strain your budget more than the loan payment alone. Here is a practical action plan. First, open a secured credit card with a modest deposit, such as $200 to $500. Next, use it for small, predictable purchases like gas or groceries. Keep your utilization under 10% and pay the balance in full each month. Automate payments to avoid missed due dates. Monitor your credit score and spending regularly. After 6 to 12 months of on-time payments, consider a second product or an upgrade to an unsecured card only if it supports your goals and budget. This approach builds payment history, the most critical factor in your credit score, with minimal cost. This flowchart visualizes the credit-building flywheel. Starting with a secured card, you make on-time payments that create a positive payment history. Over time, this improves your credit score, which opens access to better rates. With lower interest costs, you have more money available to save or invest, strengthening your overall financial position. The cycle reinforces itself as you maintain on-time payments and continue building credit health. Quiz time. If you finance $10,000 at 25% APR for 48 months, about how much total interest might you pay? Is it about $1,200? About $3,000? About $5,900? Or about $9,500? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about $5,900. At 25% APR for 48 months on a $10,000 loan, the estimated interest is roughly $5,900, which is more than half the principal. This highlights how expensive high-interest auto loans can be. Here is a concise checklist. First, price a reliable used vehicle under $10,000. Next, obtain insurance quotes before you shop. If you have the cash, use it and avoid high interest rates. Then, open a small secured credit card and set up automatic full payments. Keep your utilization under 10%. Finally, track your credit score monthly and reassess your strategy at 6 to 12 months. Second quiz. What is the most cost-effective first step to build credit with no history? Your options are: finance a newer car at a high APR, open a secured credit card and pay in full monthly, apply for multiple personal loans at once, or ignore credit until your income is higher. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to open a secured credit card and pay in full monthly. This approach builds payment history, which is the most influential component of your credit score, without incurring expensive interest charges from high APR loans. These are the key takeaways. First, zero credit borrowers commonly encounter 20 to 25% APR auto loans. Second, financing a depreciating asset to build credit is usually a costly strategy. Third, if you have the cash, buy a reliable used car under $10,000. Fourth, secured credit cards are a low-cost way to build payment history when you pay in full each month. Fifth, always price insurance before purchasing a vehicle. Finally, invest the savings you keep by avoiding high-interest debt and let compounding work in your favor. To summarize, high APRs make $10,000 loans surprisingly expensive. Insurance can quietly exceed your car payment, so always obtain a quote first. Use a secured credit card to build history while paying in full. Buying with cash and choosing an older, reliable car reduces costs and increases flexibility. Save and invest the money you keep by avoiding high-interest debt. Thank you for watching. If you found this helpful, please like the video, share it with a friend who needs to see it, and subscribe for more practical money strategies. In the comments, tell us your plan. Will you pay cash, shop under $10,000, and start with a secured card? We would love to hear your thoughts and questions.